In the previous episodes, we talked about the power of investing and compound growth and learned how buying and holding stocks and bonds can help you realize that compound growth. But that leaves a giant question. Which stocks and bonds do you buy? It turns out that trying to pick which stocks will do well in the future is extremely difficult. Even if you devote your life to analyzing stocks, you're still unlikely to be able to consistently pick stocks that will do better than the market. Plus, ain't nobody got time for that. That's where mutual funds come in. A mutual fund is a bunch of money, a fund, that a bunch of people mutually contribute to. A mutual fund. Each mutual fund has a manager who does the research and picks and chooses stocks for you. So mutual funds are a great way to invest simply. You just put your money in and let the smart mutual fund manager do all the research while you benefit from the investments. That sounds great, but there's a problem. Those mutual fund managers charge a high fee for their service, and study after study show they overwhelmingly lose to the market after accounting for their fees. So enter the almighty index fund. An index fund is a special kind of mutual fund. Instead of paying a smart manager to pick stocks for you, an index fund buys every stock in a list or index at an extremely low cost. For example, the S&P 500 is an index of the 500 biggest companies in the US. So an S&P 500 index fund is a mutual fund that simply buys the 500 biggest companies in the US in proportion to their size. So when you own an index fund, you're guaranteeing your fair share of the growth and profits of the entire market. In my opinion, buying and holding index funds is the most effective and efficient way to build wealth. Let's take a look at how this looks in real life. Every mutual fund and index fund has a ticker symbol, which is a short string of letters like this. WFDEX is the ticker symbol for a Wells Fargo mutual fund that attempts to beat the US stock market. If we Google this ticker symbol, we can find the Morningstar page for this mutual fund that has tons of information about it. We can see that it has a load of 1%, that's a fee you pay when you buy it, and an expense ratio of 2%, that's a fee you pay every year you hold it. If we scroll down and look at the chart of the performance, the blue line is this mutual fund, and the red line is the index it's trying to beat. You can see it's getting crushed by the index. Over the last 10 years, it's lost to the index by about 3% per year. So for all those high fees you're paying, you're not getting a very good investment. Now let's take a look at VTSAX. This is a total US stock market index fund. You can see that this has no load, it's free to buy, and an annual expense ratio of 0.04%. That's 50 times cheaper than the last fund. Now let's look at the performance. The yellow line is the average of all mutual funds that try to beat the US stock market. And the red line, again, is the index of the US stock market. You can't really even see VTSAX because it's right on top of the index and crushing the average. That's what mutual funds and index funds are. Check out the next episode to learn about asset allocation, which is which index funds to buy, and how target date index funds work. See you then.